The question I posed or said I was going to pose at the end of last class was the Fed to blame for the housing price bubble? So some economists argued that because the Fed kept rates so low for so long, from 2003 to 2006, because they were so concerned about deflation, that they helped cause the housing price bubble. Because interest rates were low, people were more willing and able to borrow. And then when they had to increase rates in like 2005, 2006, a lot of mortgages that appeared to be kind of easy to repay were a lot more difficult for people to repay. So helping cause the boom and the bust. John Taylor, who is an economist at Stanford, who developed the Taylor rule that is basically an equation that combines inflation and output to determine what the federal funds rate should be. And throughout the 90s and into the early 2000s, like 2001, 2, the Federal Reserve basically followed the Taylor rule, like within I think like 25 basis points. He argued that the Fed kept interest rates too low, and that led to low mortgage rates. It stimulated housing demand, and then encouraged subprime mortgages being issued on those, and encouraged a lot more people with poor financial or income histories to get to apply for mortgages and to get mortgages, which increased just the number of subprime mortgages, made it a lot easier to securitize because there's so many. Both of which led to the housing prices, a rise in housing prices, and a housing bubble. As we talked about before, obviously this isn't the only thing going on, because there's land use regulations, zoning regulations that are making it a lot more difficult to buy or to build housing in these large metropolitan areas. So the Case-Shiller 20 city index, that's like the 20 biggest cities. Most of those are closed access. It's very difficult to build new housing. So supply can't adjust, even though demand's steadily increasing. Federal Reserve Chair Ben Bernanke countered this argument. Surprisingly, the guy in charge of interest rates disagreed that interest rates were too low. Saying the culprits were the proliferation of new mortgage products. So these new mortgage-backed securities, CDOs, credit default swaps, all these new financial products based on mortgages that help lower mortgage payments. Obviously, if you're a mortgage originator and you're going to give give a mortgage to somebody, but you're immediately going to securitize it and sell it to someone else, you don't care about putting 20% down anymore. My parents bought a house in '92, and I think they put like 15 or 20% down, which was like a little bit more than the norm back then, but they're really cheap or risk adverse, financially risk averse. I think that's a nicer way to say it. But that fell to people in the crisis putting down 5%, 1%. You could get loans where you didn't have to put down anything. So lower relaxation of lending standards, lower mortgage payments and down payments, because these banks are getting them off their balance sheet. They don't care that it's now riskier because these people are putting down less money. So there's more people coming into the housing market because there's lower lending standards, more subprime borrowers are able to get mortgages, and there's capital inflows from emerging market countries. Additionally, I don't think Bernanke argues this, but according to the measures of inflation at the time, inflation was extremely low. Now, this low inflation was largely due to productivity gains. So this is the good kind of low inflation or deflation. So had we fallen into deflation, that wouldn't have been a bad thing, unlike the deflation that accompanied the Great Depression and the little bit that came with the Great Recession. That wouldn't have led us into a deflationary spiral because it was all driven by productivity. But the Fed was concerned about that. Interest rates under the end of Greenspan, or inflation under the end of Greenspan and the beginning of Bernanke was extremely low at the time. And afterwards, we revised the inflation measures upwards. So in real time, it looked like monetary policy was not that accommodating. That it wasn't like overly accommodating. But in hindsight, it turns out it was. And there was no way for the Fed to know that at the time. So it's hard to blame them when, even if using the Taylor rule, they would have still kept interest I mean, they were lower than what the Taylor rule suggested, but even using Taylor rule data, then lower than what the Taylor rule using current data would have suggested. So there's still ongoing debate whether monetary policy was to blame for the housing bubble. Personally, for the bubble itself, I don't think monetary policy was that big of a deal. Obviously, rates, in hindsight, rates should have been higher. But there's so many other things going on to inflate the mortgage market that I don't think you can just pin all the blame on the Federal Reserve like I don't know, like someone like Ron Paul. But I like Ron Paul, but his arguments with Bernanke on the House Financial Services Committee were so awesome. And he would just bitch at him like, "Why are you doing anything? We should be on the gold standard."
Yeah, he's
Just like a cranky old man yelling at him. It was awesome.
audit the Fed.
Yeah, I guess I'm a bad libertarian because I don't want to audit the Fed. I don't understand what it's going to do. I've asked people, I'm like, well, the Fed's evil. We got to find out what's going on. I'm like, well, you know what's going on. You just want to know what assets they're holding?
Yep.
We have the general idea. It's mostly short-term assets. A bunch of agency mortgage-backed securities since the crisis, and they're going down. Like long-term government debt.
They're the only government agency that is not audited by the GAO.
Oh yeah, have you seen the DoD's audit?
I mean,
They were required. Oh yeah, they're the only one legally not required to do it
Yeah.
for the GAO, but we're still waiting on the initial audit from like '93 for the DoD. There's defense. There's like two other ones who like haven't done one, and a lot of them do their audits really crappy.
Well, in the changing of the law, they're even like the GAO is allowed to like get information from the Fed now, but like they were asking the person that audited the Fed like specificities about the balance sheet, and they're like, "Yeah, we don't know." I was like, "Oh, that's good. Then what do you actually get to do?"
I don't know what they do in the audits, but I don't know. It's just a way for Congress to get power over the Fed, and that's the last thing I want. Anyone who like appreciates an independent Federal Reserve like shouldn't want that. You think fiscal policy's bad with targeting swing districts right before elections? Imagine if we're doing that with monetary policy. I'm sorry. Imagine we're doing monetary policy again.
Yeah, again.
It's because stagflation worked so well last time. Okay, so I think I just left this in from the book. There are slides about the financial crisis. So the stock market crash in fall 2008 picked up speed, beginning the week October 6th, which was the worst weekly decline in U.S. history, even worse than the Great Depression. As you remember, my high school had the stock picking game that started literally that week. So we picked our stocks, and the next day it crashed, and we just gave up. Interest rates surged during that time for borrowers, so there were sharp declines in consumer spending and in investment. The good times, so to speak, had run out, so consumption began to fall as people became more worried because, the economy is a lot, confidence game. People lose confidence, things start to deteriorate. The unemployment rate quickly increased, going up over 10% by late 2009. And the recession was the worst economic contraction since World War II. A little bit of information here, more stuff to say. So on April 30th, 2008, the Fed announced that it will not cut the federal funds rate below 2%. The recession wasn't declared by the NBER until that December. The National Bureau of Economic Research, they're the ones who basically says whether we're in a recession or not. And they do it by either 2 or 4 quarters of negative economic growth. So if GDP contracts for basically like a whole year, they do that. Sometime, if it's really sharp for 2 quarters, they'll also call that a recession. Actually, I'll save the rest of this for later when I talk about Scott Sumner. Okay, so in I think late 2009, Alan Blinder gave a lecture for University of Princeton students. It was part of like a 6-part lecture series by leading economists talking about the financial crisis and what was going on, and it was still like going on at this time. They're available for free online, so if you're a nerd or if you need something to fall asleep listening to over Christmas break, it's a free way to do it. Talking about the crisis, he said, and I like this quote, so I wanted to include it, that the errors are massive and multiple to reach a crisis. So many times when people talk about what was going on or what happened with the crisis, what caused the crisis, like you listen like politicians or like talking heads on TV, they pick one scapegoat and they say it's their fault. But really, there were so many things going on to reach this, you can't just blame one thing for causing the crisis. You truly internalize money free and unfree.
All of the problems in the United States are traced back to the Federal Reserve System.
Now, I wish I would have included a picture on here from the Margaritaville episode of South Park, where Randy's up there preaching, his finger pointing gets us nowhere. Steve. So Blinder says that the safeguards failed and the lifeguards must have been taking a nap to allow this to happen. He lists 10 different people, or 10 different culprits that he blames the crisis on. And then I had 2 more that he didn't include. The first culprit that he blames is the bond market. So the safe interest rates, the very low risk interest rates, so things like government, like the US Treasuries, or government debt from other well-established, high-income nations, along with other like super safe assets. They had very low interest rates in the low 2000s. Interest rates had fallen. I showed the federal funds rate graph earlier. It was super low by the early 2000s, from their peaks at like near 20% in the early 1980s. So yield was much, much lower than we had dealing with in the past. So what we had was investors, what they call reaching for yield, or stretching for yield. Instead of getting these super safe assets, they're moving up into riskier and riskier asset classes, trying to get a return for their clients. Because if you're managing your client's assets and you're only getting a 2% return, you're saying, yeah, but look, inflation's super low and there's no risk. There's very low risk. They're gonna say, I don't care, like, I was just getting 6%, 8% last decade. Why can't you do it for me now? Not taking into account inflation, and also worrying less about the risk, especially because they have such a low risk portfolio. And of course, if you're managing someone's assets, you want a higher return so you can get, a bigger commission on it. It's supposed to align incentives, but in this case, when interest rates on safe assets are so low, it can cause problems. So at this point, things like junk bonds, so really risky companies, and government debt from, say, emerging market countries, so like Bulgarian government debt, these become a lot more attractive. So it's like that 4 sitting at the bar at 2 a.m. It's not looking good, but in this environment, suddenly it looks great. Lending risks seem to be minimal. Because we haven't had, like at this point, severe contractions in a while. It had been a while since the Latin debt crisis or the South Asian crisis, with those governments defaulting on their loans. People were a lot less concerned about the downside for these investments. This can pose a serious problem for institutional investors, especially when they have, when their models for risk try and estimate returns only goes back, say, 2-3 years. If we have, like a 5-year bull market, their models don't take into account downside risk, and they make it appear like the portfolios are a lot more safe than they actually are. So when I was an undergrad, I interned in like the summer of like 2014, I think, for a wealth management firm, and it was like a small thing in Williamsport, and they said that they didn't really have like a big research staff, and they didn't really usually have interns, but they were looking for one that year. They said we need someone who just all they can do is backtest these portfolio models going back like 6 or 7 years instead of like the normal 3 that they do, because we were far enough away from the stock market crash and the recession that it was just like a long bull market. And our model is, they said that their model was basically going to just look at stocks that are good like during the boom part of the cycle and not ones that could withstand a bust. So if there was a stock market decline, their portfolios would have suffered substantially. They were smart enough to recognize this ahead of time and to like spend time trying to account for the downside risk. A lot of institutional investors through the 2000s didn't. So they ended up thinking they were a lot more safe than they were, and they weren't taking into account the long run risk that they should have. So in a safe environment, especially when it's safe for a long time, they don't take into account the possible downsides, giving them a false sense of security. When models are short term, like I said, they overlook this long term risk. They don't take into account, and that's what we've seen happen. So to give an example, let's say So the yield on safe assets is about 2%. The yield on like junk bonds is 3.75%. So that's 175 basis points greater that you're getting by shifting to a riskier portfolio. But that's still 175 basis points isn't that big for a bonus. So if you're a rational investor on Wall Street and you want to up that bonus you're getting, how do you do it? What they did is they leveraged. These banks began to leverage. So if you leverage, you borrow a bunch of money to invest. Say you leverage by 10 times, that 175 basis points that you're getting your bonus from now became 1,750 basis points. That's a lot bigger. So we saw a lot of firms on Wall Street leveraging themselves, borrowing money to invest in order to perform a lot better. So this it magnifies your returns. You're getting a lot greater returns by doing it, but also magnifies your losses. So I didn't include the numbers. If you see a slight decline in these values, this can have catastrophic effects for the firm's overall balance sheet because so much of their assets are being paid for by borrowed money. So I say at the bottom of the slide, shockingly, pay for performance caused people to try to game the system. The idea is by incentivizing these, these money managers, these portfolio managers on Wall Street, incentivize them for their performance, pay them for greater returns, is they're going to get their clients greater returns. They're going to make them better off. But at the same time, it's causing them to take on more risks to do that. So while this model of pay is an attempt to align incentives for both the money manager and for the person whose money they're managing, it still causes problems. One of the things that you should keep in the back of your head when thinking about or when reading about the financial crisis is think of the incentives at play. Obviously, if if an action becomes more costly for a person, they're going to do less of it. If it becomes less costly, or if their benefits increase from doing it, they're going to do more of it. Okay, so we end up seeing a bubble in fixed income, so in both mortgage-backed securities and in junk bonds, which investors were investing in to chase yield. August 9th, 2007 is when the subprime mortgage-backed security holdings of the French bank BNP Paribas, when they had reached a point that they became insolvent. And that was considered the crash of the housing bubble. Next, Alan Blinder blames ordinary Americans.
Oh, dang. Ordinary Americans.
These people, they wanted more even though they didn't have money, so they borrowed and they bought their Margaritaville frozen margarita machines with the salsa dispenser, even though they couldn't afford it. But no, they participated in the housing mania. These people bought houses. Like, you can't. They do, I don't know, have some blame because they took part in it. They expected the prices of housing would rise forever and keep rising at that pace. These faulty expectations led them to take out adjustable rate mortgages that would not be profitable for them, wouldn't be really possible for them to do if housing prices didn't increase at that pace. This is a hint. Housing prices can't rise forever because they're a component of GDP, so it can't be greater than GDP. That's something Blinder points out, is they can't just keep growing and growing at that pace relative to the rest of the economy, like people were thinking at the time. At a certain point, it's got to stop. Subprime borrowing. If you have a poor income stream or inconsistent income stream, if you don't have a good credit history, it's generally a bad idea, despite the encouragement from government programs and the banks who are more than willing to lend to those people and then sell it so they didn't have to bear any of the risk. Adjustable rate mortgages are also a bad idea if prices don't keep going up and if interest rates overall don't keep falling. If you did an adjustable rate mortgage in 1990, 1985, 1995, it would have been a great idea because interest rates were falling and continued to fall. And housing prices generally rose. Doing it in 2005 is a terrible idea because of timing. He gave an example of the 228 mortgages, which had a 2-year low teaser rate, and then from there it adjusts up to a multiple of the LIBOR. He's also often included zero money down. So you're literally not putting any money down on the house when you buy it, which again is riskier. A lot of times what people did was refinance after 2 years to a lower mortgage rate. And they were able to put a lot more down because they already had equity in the house. So they could put like a down payment on their new refinance mortgage. The next culprit he blames is mortgage lenders. Blames both the banks and the government-sponsored enterprises, so Freddie and Fannie. That there were a lot of grifters, con men. As when you know you're near the peak of the bubble is when you start seeing fraud and those sorts of, you see reports on the news of people defrauding people in whatever market is the bubble. There were also very lax standards. Again, because banks are getting this risk off their balance sheet, they didn't care. Think of the incentives at play there. They were giving ninja loans, so no income, no job, no assets. And some even gave no doc loans where you didn't have to give them any documentation or proof of really anything. Because they were going to securitize it and get it off the balance sheet so quickly that those people could not default. So Blinder suggested making originators hold on to 10% of the loans that they originate. His idea is to prevent the moral hazard with just getting those off your balance sheet so they don't care about risk, making them keep a slice of them forces them to do more due diligence. You guys see any problems with that? Could they get all the, could they just keep, like, do 10% that are good, and all the 90% have them be shit?
Yeah. That'd be a good thing to do.
Is forcing banks to hold a certain amount of assets?
Could they hold
Is
like
that too much
10%
meddling?
of one loan somehow?
I think that's the idea, is combine them into mortgage-backed securities. So say put 100 mortgages into one security and then take a slice of it. It definitely moves incentives more in line, that they're now doing their due diligence. On the one hand, market forces, there's reputation mechanisms that if you're buying mortgage-backed securities, you're not going to want to go to Washington Mutual, who's writing mortgages with their eyes closed. You're going to want to go to someone who takes more care. But do you want to wait for a financial crisis to happen to know who's doing their due diligence and who's not? I love the market, but I will point out there are some problems with significant side effects. This isn't just getting a bad haircut. Next, he blames bank regulators. They fail to protect consumers and to ensure the safety and soundness of banks. They did not do their job. I'm sure they tried. I'm not saying they were literally like asleep and didn't care, but they were mistaken. Friedrich Hayek refers to the knowledge problem. He mostly talks about central planning, a government central planning board like the Soviet Union, trying to determine all the goods and services in the economy, how much of each to make, how to make them, who's going to make them. But the knowledge problem also applies to bank regulators, right? Any sort of regulators. Bank regulators don't have all the knowledge they need to be able to effectively regulate an entire banking system, because no one has all that knowledge. Not the bankers themselves, not us, the depositors and borrowers. Trying to aggregate all that information from all across the country, from all these different people, is just too expensive, if it's even possible. Because there's some information out there that you don't really know, you can't articulate it until you're actually engaging in that activity. I'll give Basil an example because I've been working on that this semester. Highly rated mortgage-backed securities had very low capital requirements. They, the first round of Basel, they said every bank has to keep 10% of capital on hand. Banks complained, and people realized that they were shifting towards riskier assets. If you have to keep 10% of capital on hand no matter what, you're going to go after assets with greater yield. All things being equal. It's going to shift your portfolios. So what Basel regulators did with the prodding from financial institutions is they implemented this thing called risk-weighted capital, where the riskier an asset was, the more capital you had to keep on hand. Government debt and mortgage-backed securities are two examples of what they considered low risk. So they had to keep very few, or a lot lower capital on hand. So banks are encouraged to now keep a lot of mortgage-backed securities on their balance sheet because they can invest even more money. They keep less on hand. That's great when they're safe, but when they're risky, like we see in the crisis, that's a bad encouragement. The subprime lending trend was noticeable years before the bust. Fed Governor Gramlich, I don't know his first name, told Greenspan in the early 2000s when he was Fed chair. I said in his morning bath there, to remind myself to make the joke, every morning before work, he would take a bath and he would bring in a stack of papers and he would read through financial data in the bathtub. He's known for that. So Blinder blames ideology and poor regulation. Is that really reality? I think that's up for debate. Whether it was truly, the way he frames it is that ideology was blinding them from being able to engage in effective regulations. I don't know if that's the fairest way to say it. Ideology definitely played a role. I think Paulson, the Treasury Secretary, he didn't start until like 2006, so he can't be blamed for all the crisis. But he was a big believer in letting markets work. And he was extremely hesitant to step in and bail out financial institutions. So it definitely slowed their ability to respond to it. So it's hard to say ideology played no role. But the worst loans and the largest volume of subprime loans were at like the latest point in the crisis. So it kind of spiraled out of control towards the end. So it was, while some people noticed the subprime lending problems like in the past and said this could be bad, a lot of people didn't because, and like I said, it's hard to look at this, hard to realize that, hard to anticipate these future trends. Like subprime lending was considered a small corner of the market. That's what a lot of people thought, but it turned out by the end to be a very large portion of new mortgages. Next, he blames the private label mortgage originators. Now these are not Freddie and Fannie. These are like private banks. They package mortgages into mortgage-backed securities, CDOs, and even CDOs squared. So the idea is to reduce risk even further, combine a bunch of mortgage-backed securities into a CDO. Then, by the end, they were combining those CDOs into CDO squared, so making up a CDO out of a group of CDOs to reduce risk even more. The idea was to churn them and burn them. So to churn out a bunch of mortgage-backed securities and CDOs, get them off their balance sheet, and whoever buys them, let them suffer with the consequences. That wasn't 100% true because a ton of financial institutions had mortgage-backed securities in their own portfolios. And I mean, if you listen to Dick Fuld at Lehman, I love bringing him up. He thought mortgages were safe, and he thought mortgages were going to come back. So he thought that was a great asset to borrow on and to loan on. However, the risk management practices within like each of these financial institutions were, well, they would have been laughable if we didn't have to go through the recession afterwards. Blinder said he was shocked by how much these banks actually owned. Up to 80% of capital was tied up in mortgage-backed securities. So they're not being diversified at all. The Citibank CEO said, while the music plays, you have to dance. Defending his bank's heavy involvement in mortgage-backed securities. Not surprisingly, Citibank struggled during the financial crisis because of their exposure to mortgage-backed securities. Next, the rating agencies, I mentioned them earlier with, I guess it was last class. They assess the quality of over-the-counter assets. These like mortgage-backed securities weren't standardized. They're made up of just, mortgages from houses across the country. So because they weren't standardized, what they would do is have Moody's or S&P come in and rate like how safe the assets were before they sold them, so people knew what they were getting involved with. The idea was to safeguard consumers, reduce information asymmetry, so the people selling mortgage-backed securities and people buying the mortgage-backed securities both knew the relative safety and what was going into the asset, and to help set the price. They ended up giving AAA ratings to risky mortgage-backed securities because investment banks would say, if they didn't get a good enough rating on it, they say, okay, well, thanks a lot for your help, Moody's, but we're going to go to S&P. Well, wait. Maybe we can work with you on this. So we had a real conflict of interest there. Banks ended up negotiating ratings with rating agencies, and they'd say, okay, so you're giving this like a triple B rating. what do we need to get it up a little bit? I said, well, move this one risky mortgage and put in this one good mortgage, and then we can bump you up a rating. Turns out that was not the best idea. Another culprit is securities firms. There was a mountain of complex derivatives that were on top of these securities. Over-the-counter like derivatives are a huge source of fees for financial institutions. A great way for them to make money. So they were more than willing to do that. These firms had excessive leverage, so Bear Stearns was leveraged 30-1 at their peak in the crisis. So a 3% drop in value of their assets would leave them insolvent because they had to pay back their creditors. Most of the funding was overnight Fed funds, not for Bear Stearns, but for like actual commercial banks, and then the investment banks would use like overnight repos and short-term borrowing in order to fund themselves, borrowing from other financial institutions overnight to meet their liquidity needs. But in good times, that's great. It's also good that it encourages banks to constantly be looking at each other's balance sheet, assessing their risk. But if value declines in your firm, if there's liquidity concerns, that's really bad. Now these firms are unable to borrow to fund themselves. And a huge part of the crisis were all these financial firms trying to find ways to get money, to meet their capital needs, and to be able to fund themselves to operate as their balance sheets are deteriorating. Because no one trusts them. Excuse me. Next, he blames the SEC by name. Says they did not stop the over-leveraged banks. They did nothing to even try to encourage them to reduce their risk. At one point, I think like 2000, the CFTC wanted to gain some oversights over derivatives because, again, there's no regulation over derivatives, or there was none at the time. Excuse me. The SEC and the Fed basically just ignored them and blew them off. They didn't want to get involved with any sort of regulation in adding new regulation to the derivative market. The idea being that derivatives are designed to meet very specific needs for institutions that want to hedge their investments. So coming in and regulating them, standardizing them, would just defeat the purpose of that. But it might have helped reduce risk. Next, he blames a leadership vacuum. He says the president and the Treasury were passive throughout the entire housing bubble and even the initial part of the crisis. Treasury was extremely slow to react to failing institutions. They didn't want to do TARP for months. They finally, when the crisis got bad enough, decided to do TARP. And even then, it took time to convince Congress to let them do it. Had they done that much earlier, things could have turned out much differently. I'm not the biggest fan of TARP, but doing it earlier rather than later would have been much better. Anyone can admit that. Much of the crisis occurred during the lame duck period. So after Bush, he couldn't run for re-election, but so like some of Congress was being replaced after their election, but they were finishing out their terms. Bush was finishing out his term. He didn't want to do too much because there's a new president coming in. Normally, not much happens during the lame duck period. This time, there's a lot going on. So he did end up working with Obama through some of it because Obama was coming in. He didn't have his own team of advisors yet, but they were trying to work together to figure out, what to do, what to respond, because they couldn't just sit there. Finally, Blinder blames whoever decided to let Lehman Brothers fail, and that's a direct quote. He wonders why they were not too big to fail. We saved Continental Illinois. That was in '84. There was a Franklin National in '74. We bailed out Bear Stearns. That was less than half the size of Lehman. Based on how the Fed had been operating, there was a tacit agreement that the Fed would step in and save any financial institution that became insolvent, that was systemically important, that was large enough, and it would cause disruption. They argued at the time, and especially afterwards, that Bear was too entangled to fail, that they had borrowed and lent so much other financial institutions that allowing them to fail would bring all those down. They would stop lending to each other, and they'd be so busy trying to unwind their positions with Bear and concerned with the systemic risk that they would stop lending to each other, which should have gone the same for Lehman. Once Lehman Brothers was allowed to fail, the tacit agreement was broken, and this destroyed the confidence in other banks or in Fed's actions. People didn't know what to anticipate. Right after Lehman failed, money market mutual fund I mentioned last class broke the buck. They could not get their collateral from Lehman Brothers, so there was no way for them to be able to keep their assets at $1 or their share price at $1. There's some additional culprits that I think maybe because he was too early, or talking about this too early, that he didn't consider. The first is Congress encouraging subprime lending. You can't encourage something and then get mad at banks for doing it. Very ironic in hindsight, the same people saying we need to encourage all Americans to own a home no matter what their level of income. Turned around and said, well, you should have been lending to these people. What is your problem? You're taking too much risk. They were taking too much risk. But there's a reason why they were taking too much risk. Remember, there's incentives at play here. There's a bipartisan effort over more than a decade to reduce lending standards to expand home ownership across the country. It's good for the heart of the country, and it's good for the pocketbook. Freddie and Fannie purchase those mortgages from mortgage originators, reducing their risk when they loaned to a subprime borrower. The government-sponsored enterprises, Freddie and Fannie, they privatized profits and they socialized losses. They were, quasi-government owned. These are terrible incentives at play. They're encouraged to take risks, much more risk than even market participants, because if those risky bets pay off, they get to keep it all. If they lose, they get bailed out with government money, and they're no worse for the wear. It combines, I don't think I have it here. Damn, a really good quote about how it combined the worst. Oh no, then probably the next slide. Never mind that. This ended up distorting the entire mortgage market. And private sector banks ended up moving to the same standards that Freddie and Fannie had. Yeah, here we go. The shapers of the American mortgage finance system hope to achieve the security of government ownership, good, the integrity of local banking, good, and the ingenuity of Wall Street. They're nothing if not, if they don't have ingenuity. Instead, what they ended up with was the ingenuity of government, the security of local banking, and the integrity of Wall Street. A problem with these government-sponsored enterprises. Finally, the Fed's monetary policy. The Fed dropped the federal funds rate to 1.5% in 03 to 04 because of deflation, ended up getting down to 1% soon after. The post hoc revisions in how measures of inflation show that inflation was higher than they measured at the time accurately. Then early in the crisis, the Fed kept the federal funds rate at 5.5%. They announced they would not cut interest rates below 2% on April 30, 2008. Soon after, the federal funds rate plummeted, or what banks were lending to each other plummeted, and they were forced to keep cutting rates. This whole time, they were concerned about inflation. They were seeing inflation while everything was collapsing due to a supply shock of largely due to oil. Very briefly summarize what happened. They ended up sterilizing the loans they did make. So they loaned to these unhealthy financial institutions that were barely solvent or were insolvent. But what they did is then they sold assets, so they pulled money from banks that were healthy because they didn't want to increase inflation. But what happens is by taking that money out, they're not having an accommodative monetary policy position. What they're doing is propping up the insolvent institutions, the barely solvent institutions, keeping monetary policy the same, not being expansionary enough. So they're not really encouraging more loans, which is what they needed at the time. Scott Sumner blames monetary policy. I don't even have him on here. He's a nominal GDP targeting guy. So he notes that nominal GDP fell from 5.4% to -3% in 2008, 2009. This is a substantial drop. This is including inflation and real GDP. Falling rates in and of themselves don't necessarily mean that monetary policy is accommodative. So dropping from 5.5 to 2% seems very accommodative. But if the neutral interest rate, where interest rates should be to keep the economy stable, if those plummet, it goes down from 5.5 to 0%, then staying at 2% isn't being accommodative, it's being contractionary. Okay, we're over time, so I'll just stop the financial crisis there. Do you guys have any questions about this?
Yeah.